Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Value Investing Principles, a beginner's guide to building long-term wealth. Long-term investment horizon. Value investing isn't about making a quick buck. It requires long-term thinking, the ability to look years ahead instead of reacting to daily market fluctuations. Why does this matter so much? Time evens out volatility. Stock prices go up and down in the short term, often irrationally. But over time, a company's true value tends to shine through. Think of it like planting a tree. The growth isn't instant, but it rewards patience. Compounding gains. The longer you hold a strong stock, the better chance you have to benefit from compounding. Reinvested dividends and capital appreciation add up significantly over the years. Align with business growth. Businesses don't transform overnight. A well-run company with growth potential needs time to execute its plans and prove its worth. Many investors lose by chasing quick gains, but value investors play the long game. The market is unpredictable in the short term, but patience helps tilt the odds in your favor. Avoiding market speculation. Speculation is the enemy of value investing. Speculators chase trends, hype, and market buzz, hoping to strike gold. Value investors take the opposite approach. They focus on fundamentals and stay disciplined. Embrace fundamentals. Instead of betting on what the market might do, value investing emphasizes data-driven decisions. Is the company profitable? Does it have manageable debt? Strong fundamentals act as a guidepost. Ignore the noise. There's always news, rumors, or hot tips that tempt people to jump on the latest trend. Value investors tune out the noise and stick to their strategy. Don't overreact to market swings. Markets go through cycles of fear and greed. A speculative investor reacts emotionally, but a value investor sees falling prices as opportunities when the fundamentals remain intact. Think of speculation like gambling at a casino. You might win, but the risks are sky high. Value investing, on the other hand, is more like farming. It's slow, steady, and requires preparation, but the results are far more reliable. By rejecting speculation, value investors stay focused on what truly drives long-term returns, owning quality companies bought at attractive prices. Financial metrics used in value investing. Value investing is all about making informed decisions based on hard data. To find undervalued stocks, investors turn to specific financial metrics that reveal a company's performance and value. These numbers act like guideposts, helping investors separate good opportunities from risky bets. Below are 3 essential metrics every value investor should know and apply. Price-to-earnings ratio, P/E. The price-to-earnings, P/E, ratio is one of the most commonly used tools for evaluating a company's valuation. It measures the relationship between a stock's price and its earnings per share, EPS. The formula is straightforward. P/E ratio equals price per share divided by earnings per share. So, what does the P/E ratio tell us? A low P/E ratio can indicate that a stock is undervalued. It suggests investors are paying less for each dollar of earnings. However, it's not always a guarantee. Sometimes a low P/E reflects poor future prospects. A high P/E ratio means you're paying a premium for expected growth. This is common with growth stocks but isn't usually what value investors are looking for. For value investors, the P/E ratio is like a snapshot of how the market values a company's earnings. Benjamin Graham often used it to find undervalued opportunities, keeping a close eye on stocks with ratios below the market average. Still, it should be used alongside other metrics to get a clearer picture. Price-to-book ratio, P/B. The price-to-book, P/B, ratio compares a company's market price to its book value. A company's book value is essentially its total assets minus liabilities, a measure of what it's worth on paper. This ratio can be calculated like this. P/B ratio equals price per share divided by book value per share. Why is the P/B ratio important for value investors? A P/B ratio below the 1st of May signaled that a stock is undervalued. In this case, the market is pricing the company at less than the value of its assets. This could indicate a bargain for investors. On the flip side, a high P/B ratio means the stock might be overvalued, especially if there's no obvious reason, e.g., future growth potential, to justify paying more. The P/B ratio is particularly useful for companies in capital-intensive industries like manufacturing or finance, where assets play a central role in the business model. However, like any metric, it's most helpful when examined alongside earnings, cash flow, and other indicators. Debt-to-equity ratio, DE. The debt-to-equity, DE, ratio is key for assessing a company's financial stability. It compares total debt to shareholder equity, showing how much of the business is funded by borrowed money versus owned capital. The formula is DE ratio equals total debt divided by shareholder equity. Here's why this metric matters so much to value investors. A high DE ratio suggests the company relies heavily on debt to finance operations. While borrowing isn't always bad, too much debt can become a burden, particularly during economic downturns. A low DE ratio is often seen as a sign of financial health. Companies with lower debt levels are typically better equipped to weather tough times. Value investors prioritize companies with manageable debt levels. After all, a company overloaded with debt may struggle to grow or even survive if interest rates rise or sales slow down. Think of it like balancing your own budget. The less debt you have, the less risk you carry. These financial metrics are foundational tools for evaluating a company's overall value. When used together, they provide a more complete picture of whether a stock is worth your investment. Understanding P/E, P/B, and DE ratios helps you make smarter decisions and avoid costly mistakes. As always, successful value investing comes down to doing your homework and knowing what the numbers really mean. Common mistakes to avoid in value investing. Value investing is an approach that rewards patience and careful research, but even the most experienced investors can slip up. Avoiding common mistakes is just as important as following the right principles. Here's a look at some pitfalls that can derail your investing journey and how to sidestep them. Emotional decision-making. Letting emotions guide your investment decisions is one of the fastest ways to lose money. Fear and greed are major culprits that cloud judgment and lead to bad calls. Fear. When markets drop, panic can set in. Many investors sell solid stocks simply because prices are falling. Instead of seeing an opportunity to buy at a discount, fear takes over, leading to losses and missed gains. Greed. On the flip side, greed can push you to chase trends or overpay for stocks hyped as can't miss. This often leads to holding overpriced stocks that crash when reality catches up. Treat investing like running a marathon, not a sprint. Your emotions will try to trick you into making impulsive moves, but sticking to your research improves your chances of success. Use tools like predefined rules or a written investment plan to resist emotional reactions, especially during market swings. Overlooking qualitative factors. Numbers might be the foundation of value investing, but the story behind those numbers is equally important. Ignoring qualitative factors can result in evaluating a stock as undervalued when it's not. Management quality. A company's leadership makes or breaks its future. Ask yourself, is leadership trustworthy? Are they making sound decisions for long-term growth? Competitive advantage. Does the company have a moat? A strong competitive advantage helps protect profits and sustain growth. Industry trends. Even great companies can suffer if the industry is shrinking or disrupted. Understand how external factors, like technology or regulation, can impact growth. Think of it this way: buying a stock solely based on financial metrics is like buying a car based on price and mileage without checking the engine. Don't ignore the qualitative aspects. They often reveal risks or advantages that numbers alone can't capture. Failing to diversify. Putting all your eggs in one basket creates unnecessary risks. No matter how confident you are in a stock pick, unforeseen events can derail even the most promising company. A diversified portfolio spreads out risk and protects you from catastrophic losses. Here's how. Invest across different sectors, e.g., technology, healthcare, consumer goods. Hold a mix of small cap, mid cap, and large cap stocks. Avoid overloading on a single company's stock, even if it seems like a sure thing. Diversification is like having a safety net. While it won't guarantee massive returns, it shields you from putting your entire investment at risk if one bet fails. By steering clear of these common mistakes, you'll stay grounded and increase your odds of success over the long haul. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.